when you are collecting from customers. When you receive interest income. So all these are inflows, cash inflow to the business. Now, when you are paying cash, which kind of transaction are, for example, paying salaries, that is outflow, expenses and all those stuff, right? So when you are borrowing money, which means cash is coming into the business, this is cash inflow. Paying off loan or retiring of the loan, outflow, cash going out from the business. Issuing stocks, cash inflow. So all these are also recorded in accrual accounting. So accrual accounting is basically one step ahead from, or it is the advanced, it is the advanced stage, or refined stage of cash basis accounting. Not only it records cash basis transaction, plus also recorded non-cash basis non-cash based transaction as well. For example, depreciation, wear and tear of the asset, you record it, but in cash accounting you don't record it because cash is not going out or coming to the business. How much I use my laptop, $100 or $1,200, I don't know, because physically I don't pay anything, right? But accrual accounting record it itself. Got it, everyone? So, like I said, the non-cash transaction also recorded by the accrual accounting. For example, sales on account, you sold to the customer, customer will pay you later. Cash is not received yet, but you record it. Purchase of inventory on account, purchasing of inventory from supplier, and you will pay later. You also record that. Transaction recorded when they occurred. Accrual expenses like salary payables. Salaries are due but not yet paid. You record it because salaries are due today. So you record it today. Maybe pay later. That's other story. When you pay, you record, you also then record it. Depreciation expense, which is non-cash, which involves no cash inflow and outflow. Usage of prepaid rent, insurance, and supplies. So you, in advance, you purchased all the supplies, stationery, glues, rubber, printing papers, and all the stuff. The cartridge of printing machines, all the stuff for a whole year, and now you are using on monthly basis, so you record it as well, right? Earning of revenue when cash was collected. Earning of revenue when cash was collected. Simple. For example, you received cash in advance before you sending the goods. Sometimes customer pay you in advance. You also record that in which cash involved, but goods are not transferred yet. Right? Okay. So the time period concept. So in accrual accounting, there must be some regular interval on which you measure your performances. Measure of the performance through financial statements like income statement, retained earnings statement, balance sheet, and cash flow statement. During what period to measure the performance? So basically, the basic accounting period is 1 year or 12 months. It can be increased to 16 months to 18 months, yes, but normally it is 12 months. But can be vary from January to December. Some uses from January to December, some uses from June to June, right? Or 30th June to 1st June to 30th of June or 1st July, right? So 60% of the large companies, but this is a figure of, because this book is US centric. So in US, 60% of companies use calendar year, January to December. Some may be using September to 1st October, right? So it depends, but normally it is 12 months. Either you are using February to February, September to September, right? So it's up to you. So here we go. A fiscal year may end on a date other than 31st of December. I just talked about that. So companies also prepare financial statements for interim period. Yes, 3 months financial statement, 1 month, 1 week, semi-annually, right? After 6 months. So it's up to the, but for publishing purposes, these interim are made for their own purposes, internal use. If they want to publish it, it means they are more transparent to the public that we are publishing it, but this is not required. Required is only once a year. So now let's just talk about, oh, by the way, you guys understand the difference between cash basis and accrual basis, right?
Yeah.
Any question?
No.
Okay. Okay, let's move forward. Now apply the recognition principle of expense and revenue. So revenue recognition principle and expense recognition principle. We just shared some light in our earlier slide that revenue must be recorded when it is occurred. Maybe collection is after something, but expense and revenue must be collected or paid or must be recorded when they occur. Simple. The simplest definition of this principle is that revenue and expenses must be recorded when it is, when it happened. So revenue principle, so it deals with two issues. Number one, when to record the revenue. Number two, what amount to record what amount of revenue to record. Number one, when to record or recognize the revenue. So in accounting terms, we call this recognize. So if you heard, any accountant using the word recognize, always remember that you're talking about recording. And recording mean journalize, making entry. Posting mean that you are posting on T accounts, right? This is credit side, this is debit side. Remember that one from our last lecture, right? So now when to record? So revenue is recognized when the business transfer promised goods or services to customer in an amount that reflects the cash or fair market value of other consideration that the entity expects to receive in exchange from those goods or services. So remember, you must when to record when it occurred. So even if it is occurred, for example, your company closes at 6 p.m. and you receive the order, but you delivered the goods are out from the company premises at 5:59, and this is 11th of October. Remember, after 1 minute the company gonna close, but since goods are out of your company premises, you must record sales in 11th of October. And the word that we use for recording, recognize. Maybe you record on 12th because tomorrow you come to the office, but the date you will mention, it must be 11th of October. What amount? It doesn't mean that, okay, this is your wife's company, so you want to give her a credit, or your girlfriend company, or your brother company, or your friend's company. Okay, the goods worth 1,000, so you are the CEO of this company, so you giving him or her or your friends or something $2,000. No, fair market value. What if you have purchased this from other, or you have sold other at a fair market value 1,000, or you are selling to your friend's company 500. If you're selling to others, you will sell 1,000. You cannot record 500. Record 1,000, which normally you deal with other customers, because you are just a manager. You are not the company owner. Company is owned by the customer, owned by the shareholders, and you are the management. You work for the shareholders, not for your friends and your family. Okay? Any question regarding revenue recognition principle? Faik, Priscilla, Peranan, Manisha,
No question.
Tara and Meena?
No question.
No, sir.
No question, sir.
All good, sir.
Tara and Meena, can you hear us? Okay, Marco and Subhan?
Hello, sir.
All clear, sir.
All clear, good.
No question, sir.
Okay, good. So this is a global view. This is just for your knowledge. So those who are watching online, please pause the video and read that. So just going to give you a little reminder here. So we have two principles. One is two principles of accounting. One is GAAP, and one is IASB, International Accounting Standard Board, right? So they have, they compete, with other, but now they are converging. They are on the same principles that how we are going to record it. Some companies follow GAAP and some company follows IASB models of accounting. So this is just for your knowledge. But mostly in United States and out of the United States, mostly company they are using GAAP. We have US GAAP, we have Chinese GAAP, we have Indian GAAP. So it's just that taxation is going to be different in every country. How you recognize, how you present the data is a little bit different in many countries, but general principles are the same. So this is just for your knowledge. So pause the video here, and those who are right now with me. So when I upload the PDF, so please just read it by yourself. So I'm not going to waste more time here. Let's move on. So apply the revenue and expense recognition principle. So we have two situations. Number one, do not record revenue. So no transaction has occurred. For example, I plan to start drinking Starbucks coffee, and Joe at the Starbucks, he said, great, we will welcome you as a customer. So any transaction occurred between these two? Answer is, since no revenue or no sales occurred. Why? Because coffee is still not handed over to the customer. When customer asks for coffee cup and agree to have, for example, a latte please, and then the owner handed over, it means sale occurred. For example, she called or she talked to the Starbucks employee here at 11 October, 12 a.m. 12:30 p.m. She talked to the manager and said, okay, I plan to drink coffee, okay, one latte please. And you take 15 minutes. When sale occurred, the coffee is handed over at 12:15. So you record the sales at 12:15, or when she pay you. So normally what happened? You go to the front corner and you pay first. So in this case, she received coffee first and pay later. But if she paid earlier, for example, at 12 p.m., she go to the shop and pay 30 yuan and said, okay, I need latte